If you have ever had the truly soul-crushing experience of having your car totaled, you know that immediate aftermath is just brutal.
Mm,
You're dealing with the emotional weight of an accident, and then the insurance company sends you an offer.
right.
And invariably, that check is lower than you expected. Sometimes, I mean, dramatically so. It's often not enough to buy the same car again, an apples-to-apples replacement.
And that gap, that space between what the insurer offers and what a replacement car actually costs, that's the core frustration.
Yeah.
And it exists because the company's valuation methods are, well, they're intentionally opaque.
Opaque, that's the word.
They rely on abstract proprietary data. It's like they're feeding numbers into this invisible algorithm that only they understand.
Yeah.
And this lack of transparency makes it incredibly difficult for you, the consumer, to challenge what feels like a lowball offer.
You feel like you're fighting a phantom, right?
Exactly.
A computer program designed to save them money.
Yep.
But you don't have to be powerless in that fight. Okay, let's unpack this. This deep dive is about leveling that playing field. Our mission is to break down the basic terms, the methodologies, and critically, the pitfalls that insurers rely on so you can gain a much stronger position to negotiate.
Today, we're going to achieve some clarity. We're going to cover the legal and financial thresholds for totaling a car, examine why the concept of depreciation is really the single biggest enemy of your payout,
Right?
and then we'll look at the necessary insurance products, like replacement cost and gap coverage, that actually protect your finances down the line.
So let's start at the very beginning of the process. You report the accident, and the adjuster comes out.
Yep.
Their first job is deciding if the car is even totaled or not. And this is a point of confusion for a lot of people because a car can still be perfectly fixable, but still be deemed a total loss.
It's a purely financial calculation. It's not a measure of, physical damage. The rule hinges on the repair cost threshold.
Okay.
If the estimated cost to sex the vehicle exceeds a certain percentage of its pre-accident value, they just write it off.
And that percentage isn't a fixed national number, is it?
No, not at all. It varies wildly. Industry data suggests it falls somewhere between 51 and 80%.
Wow, that's a huge range.
It is. An insurance company might choose a lower internal threshold, say 65%, because they figure the administrative cost and potential for hidden damage make a repair claim too risky.
It's easier for them to just cut a check.
Much easier. It keeps the repair shop out of the loop, and it speeds up the entire settlement.
So if the insurer uses a 65% threshold and the repair shop estimates $10,000 in damage on a car that's worth $15,000, they just total it immediately.
Exactly. And to complicate things further, some states actually mandate strict guidelines. You mentioned Alabama. They legally mandate the total loss threshold at 75%.
So if you live there, you know exactly what the baseline is.
You do. Knowing your state's threshold is fundamental knowledge before you even get that first estimate.
That makes perfect sense. Now, once they classify it as totaled, the next step is figuring out what it was worth, which brings us to valuation. What exactly are they valuing?
They are valuing the vehicle immediately before the accident occurred. This is critical.
Right.
They are trying to estimate what a reasonable person would have paid for that car on the open market at the moment the damage happened. So the damage from the accident is, well, it's irrelevant to that initial value estimate.
And here's where the cynicism kicks in. How do they justify their number without it looking like they're just aiming low to save themselves money?
Well, the companies have procedural steps to minimize the appearance of impropriety. They often enlist a third-party appraiser to issue a second independent estimate on the vehicle.
Okay, so a different set of eyes.
Theoretically, this report uses a different valuation methodology than their own internal system. The insurer then considers both their internal appraisal and the third-party report when they form their final offer.
That sounds good on paper, but if that independent appraiser comes back with a higher valuation, is the insurer required to honor it?
And that is a crucial distinction, and often a source of frustration. They're required to consider it, but not necessarily to adopt it. The third-party report serves as a check and balance. But if the insurer's own proprietary data supports their lower internal figure, they can still legally stand by their original number.
So you still end up fighting their lowball baseline, even with external data on your side.
You do.
That immediately clarifies why people feel cheated.
Okay, so here's where it gets really interesting, because we have to talk about the huge distinction between the insurance value, what they pay, and the actual cost to buy a new car. That distinction is the entire ballgame. And the insurance company's standard term for payment is the actual cash value, or ACV.
ACV, this is what we need to focus on. It's defined as the amount they determine someone would reasonably pay for the car on the market today. So the formula is basically replacement cost minus depreciation.
Which means, by definition, ACV is designed to be beneficial to the insurance company.
Yeah.
It prioritizes their liquidity over, parity for the owner.
Right, and they look at this huge laundry list of factors to determine that ACV. It's way more detailed than just a Blue Book number.
Much more.
State Farm, for example, explicitly lists things they factor in: year, make, model, mileage, of course, but also the overall mechanical condition, major options, previous accidents. And this is the part that hits hardest: normal wear and tear.
That wear and tear factor is where the subjective, granular nature of ACV valuation truly punishes the owner.
How so?
We're talking about things like minor body dents, scuffs on the wheels, or even those soda stains you mentioned on the upholstery. If you haven't meticulously maintained the interior, they will use that against you to justify a lower ACV.
Wait, let's stop there. You mean a few minor interior blemishes could actually reduce the payout by hundreds of dollars? How is that even quantifiable?
Oh, it is quantifiable. Within their proprietary software, absolutely. They treat the condition rating as an adjustable multiplier.
Wow.
So if a comparable vehicle in their database is rated excellent and yours is rated just good because of those cosmetic issues, they apply a negative adjustment. And on top of that, they factor in supply and demand for that specific car in your local area.
Okay, so if you own a niche vehicle that's hard to sell in your town, the ACV might drop even if the car is rare nationally.
That's exactly right.
So ACV is a snapshot of the car's current, used, less than perfect state, all tailored to the local market. Now, contrast that with replacement cost, which is the alternative solution.
Replacement cost insurance pays you the current market rate for a brand new car in the same class as the wrecked one. It often doesn't even regard specific wear and tear or mileage.
So it ignores all those little factors that drive down ACV.
It does, which is obviously much more beneficial to the owner.
It sounds like the perfect solution to the ACV problem, but it must come with a cost, right?
A significant cost. Replacement cost policies require much higher monthly premiums because the insurer is taking on the risk of 100% replacement value without factoring in that inevitable depreciation.
So it's a trade-off. You pay more upfront for total protection later. Let's move to the single biggest factor destroying consumer payouts: depreciation. You drive a car off the lot and immediately lose value. It's just brutal, and it's immediate.
It is the brutal reality of car ownership. I mean, simply driving a new car off the lot depreciates its value by as much as 9 to 11%.
9 to 11%.
That value is just gone the moment the keys are in your hand.
Wow, up to a tenth of the value lost in the first mile.
And it accelerates rapidly. By the end of the first year, depreciation typically hits 20%.
20%.
So if you total a new car only 12 months after buying it, the ACV will be shockingly lower than your original purchase price. And since the ACV offer is inevitably going to be less than what it costs you to buy a similar new vehicle, your only options are to accept a step-down car or supplement the payment with your own funds.
That's the common consequence. But the worst-case scenario involves financing, especially if the car is new and you still have a big loan. You can end up with negative equity, meaning the insurance payment is less than what you still owe the bank.
This is a huge, silent risk. It often happens if the buyer took advantage of special financing that eliminated or minimized the down payment. You drive off the lot with essentially zero equity or even negative equity from day one.
So if an accident happens shortly after, the insurance check based on ACV can't pay off the loan in full.
It can't.
So if the insurance check is, say, $18,000, but I still owe $20,000 on the loan, that $2,000 remainder has a very specific and scary name.
That remainder is the deficiency balance. And here's the mechanics of why this is so dangerous. The car, which was the collateral for the loan, is now destroyed.
Right.
Which means that $2,000 deficiency balance is converted into unsecured debt.
And unsecured debt is much scarier. Tell us why the bank suddenly gets so aggressive about collecting it.
They get aggressive because the lender no longer has an asset to seize. With secured debt, they could just repossess the car. Now that collateral is gone, the only leverage they have is pursuing you directly. Lenders often sell that unsecured debt to collection agencies who can seek a civil judgment against you. If they win, that judgment can absolutely lead to painful financial consequences like wage or bank account garnishment.
forcing you to pay off a car that no longer exists.
A car that no longer exists. It's a true financial disaster scenario.
Thankfully, like the replacement cost issue, there is an explicit solution to this negative equity problem: gap insurance.
Gap insurance. It's designed specifically to cover that deficiency balance. It pays the ACV proceeds to the lender, and then it covers the remaining balance left over, ensuring your debt is paid off in full.
It literally bridges the financial gap.
That's exactly what it does.
And as a tip for you listening, while gap insurance is vital if you have zero or negative equity, it's not always necessary. If you put a very large down payment on the vehicle, say 40% or more, or if you bought the car outright for cash, you have little need for it. Always compare premiums and costs before purchasing.
Especially since the dealer offered gap insurance can sometimes be marked up significantly.
100%. Okay, so we've covered the entire system that seems to work against the consumer. Now, what does this all mean for someone negotiating with an insurer after they've been handed a low ACV offer? Can you ask for more money?
Yes, you can.
Yes, you can. You absolutely must ask for more money.
But as we said, you can't just stamp your feet. You need ammunition. You need research and a supported reason for receiving more money that speaks directly to their internal ECV methodology.
Right. So the first, most powerful action item is challenging their comparable vehicles. If you disagree with their valuation, you need to research the ACV of similar cars using specific, valid comparison data. We're talking more than just an average book value here.
You need to find at least 3 comparable vehicles currently for sale in your local market.
Currently for sale.
Yes, with similar mileage, features, and condition. And crucially, they must be vehicles that are listed for a price higher than the insurer's ACV offer. When you provide current high asking prices, you challenge the core of their local supply and demand factor.
That's a great tactical distinction, using listed prices, not just historical sale data. Okay, second, know your state's total loss threshold, like that 75% rule in Alabama.
Knowing that number helps you understand the adjuster's baseline calculations. It confirms that your car meets the definition of a total loss, rather than some questionable repair job.
And third, gather your documentation.
Yes, this is where your maintenance records matter most. If the insurer lowered your ACV based on wear and tear, you must counter that with proof of recent high-value parts replacements, new tires, a recent transmission overhaul, a brand new audio system.
Anything that adds genuine, measurable value.
Any recent investment you must present as evidence.
And finally, there's the formal path if negotiations completely fail.
Right. You can invoke the appraisal clause, though the insurer usually has to approve your choice of appraiser. Having an independent expert assessment, paid for out of your own pocket, is sort of the nuclear option, but it provides the necessary independent weight to push back against their internal algorithms effectively.
Okay, so let's synthesize our takeaways here.
Dealing with insurance companies after a total loss is inherently difficult because the specific formulas and methodologies they use to crunch your car's value are private, not public.
It's that black box again.
It is. ACV, rapid depreciation, and the adjuster's criteria are all designed to minimize their payout.
The bottom line here is that the knowledge itself is power. Familiarizing yourself with the exact levers they pull, ACV adjustments for wear and tear, state thresholds, the definition of negative equity, is the only way to gain a powerful negotiating stance.
It's the only way to ensure you aren't left paying for a car you no longer own, or driving away in a vehicle that's a significant step down. We covered the specific factors they use: mileage, condition, local market value. But the specifics of the proprietary data they feed into those esoteric valuation models remain a closely guarded trade secret.
Which raises the final, provocative question for you to mull over. What would truly change if every insurer were legally required to instantly reveal the specific 3 comparable vehicles and the precise mathematical formula they use to arrive at your actual cash value? Think about the radical transparency that would force upon the entire auto insurance market.